I want you to imagine a machine, a massive industrial engine sitting in the center of a sealed room. It is the size of a cathedral. It is roaring with such intensity that the concrete floor beneath your feet is vibrating. To the untrained eye, this machine represents the pinnacle of power. It represents infinite energy. It represents the future. But I want you to walk closer. Ignore the deafening noise of the pistons. Ignore the blinding light coming from the furnace. Put your hand against the metal and feel the temperature. It is running too hot. Now, look at the fuel intake valve. This is where the horror sets in. This machine is not being fed by an external fuel source. There is no pipeline coming in from the outside world. Instead, you see a robotic arm reaching into the machine's own gearbox, ripping out vital steel cogs, grinding them into dust, and feeding that metal dust back into the furnace to keep the fire burning for one more second. The machine is eating itself. It is cannibalizing its own structural integrity to create the illusion of forward momentum. Every rotation of the engine weakens the frame. Every burst of speed brings it closer to catastrophic structural failure. The smoke pouring out of the exhaust does not smell like gasoline. It smells like melting iron and burning cash. This is not a scene from a dystopian science fiction novel. This is a clinical description of the United States technology sector right now. We are standing over the body of the current market cycle, and we are performing a financial autopsy in real time. What you are witnessing is not growth. It is not evolution. It is a crime scene of circular financing that amounts to $176 billion of hollow liquidity. We need to dissect this number, $176 billion. This represents the capital expenditure injection that the major cloud hyperscalers, the digital sovereigns of our era, have poured into the artificial intelligence ecosystem in just the last 12 months. On the surface, the headlines scream that this is the new industrial revolution. They tell you that we are entering a golden age of productivity. But as a forensic analyst, I do not look at the headlines. I look at the ledger, and the ledger is bleeding. Here is the mechanics of the fraud. This is the autopsy of the infinite loop. The largest technology companies in history are sitting on massive piles of cash. They need to show growth to Wall Street, but the organic consumer market is tapped out. You can only sell so many phones. You can only serve so many ads. So what do? They take their own cash reserves and they invest billions of dollars into artificial intelligence startups. They hand over a check for $10 billion to a flashy new company that promises to build the digital brain of the future. The market cheers. The stock price goes up. It looks like a bold investment, but follow the money. Where does that $10 billion go? Does the startup use it to build factories? No. Does it use it to buy raw materials? No. The startup takes that same $10 billion and turns right back around to sign a cloud computing contract with the exact same company that invested in them. Microsoft invests in OpenAI. OpenAI pays Microsoft for Azure cloud credits. Amazon invests in Anthropic. Anthropic pays Amazon for AWS servers. Google invests in DeepMind and others. The money flows right back to Google Cloud. Do you see the Ouroboros? Do you see the snake eating its own tail? This is not revenue. This is a hallucination. This is what we call the nominal illusion. The tech giant books the investment as an asset on one side of the ledger and then books the returning cash as revenue on the other side. They are taking money from their left pocket, handing it to a middleman and putting it into their right pocket while telling the shareholders they just made a sale. They are artificially inflating their revenue growth numbers by simply moving their own capital in a circle. In forensic accounting, we look for something called round-tripping. It was the exact same mechanism that killed Enron. It is the practice of selling an asset to another entity while promising to buy it back, just to book a profit in the interim. The current artificial intelligence boom is effectively a $176 billion round-trip ticket to nowhere. The mathematics here are brutal. They are unforgiving. A real economy relies on external value creation. Someone makes a chair, someone buys the chair with money earned from farming wheat, new value enters the system, but in this closed loop, no new value is entering. The energy is strictly internal. And just like the machine eating its own gears, this process is subject to the laws of thermodynamics. You lose energy to friction every time the money moves. The lawyers take a cut, the bankers take a fee, the operational overhead burns a percentage. So not only is the revenue fake, but the capital base is shrinking with every rotation. They are burning the furniture to heat the house. Let's go deeper into the pathology. Why does this matter to you? Why should you care if trillion-dollar companies play games with their balance sheets? Because this artificial liquidity is propping up the entire S&P 500. It is the only thing keeping your pension fund, your 401k, and the global bond market from realizing that the emperor has no clothes. When you strip away this circular financing, the actual growth of the technology sector collapses. The price-to-earnings ratios are not just high, they are mathematically impossible. We are looking at valuations that assume this machine can run on its own gears forever. But eventually, there are no more gears to grind. We saw this in the year 2000. We saw this in the year 2008. The mechanism changes, but the autopsy report is always the same. It is always a crisis of liquidity masked as a crisis of innovation. This $176 billion creates a demand shock for hardware, specifically graphics processing units, that is entirely artificial. It is not based on consumer demand. It is based on speculative capital expenditure. They are building data centers the size of small cities to train models that have no clear path to profitability, paid for by money that is simply looping in a circle. When the music stops, it will not be a slow decline. It will be a seizure. Imagine the machine again. The moment the robotic arm reaches into the gearbox and finds nothing left to grab. The moment the friction overcomes the momentum. The screech of metal on metal will be deafening. The silence that follows will be worse. This is the phase where the smart money exits. They see the loop closing. They see the efficiency of the capital dropping to zero. They are quietly converting their paper gains, their nominal illusion, into tangible sovereignty. They are buying farmland. They are buying energy infrastructure. They are buying gold. They are getting out of the loop before the centrifuge tears itself apart. You need to understand that we are currently living inside a lag period. The cyanide has been swallowed, but the body has not yet hit the floor. The markets are celebrating the injection of capital, unaware that it is the patient's own blood being transfused back into his arm. We are performing this autopsy on a living subject to warn you. The collapse of a circular financing scheme is always sudden. It works perfectly until the very last second. It looks invincible until it is insolvent. The deficit between the narrative of AI revolution and the reality of accounting gimmicks is the widest gap I have seen in my career as a forensic analyst. Do not be mesmerized by the flashing lights of the machine. Do not be seduced by the noise. Look at the fuel line. It is empty. The fire is consuming the engine block. I need to know who understands the gravity of this crime scene. I need to know who is watching the liquidity drain out of the system from a high altitude, observing the movements without getting trapped in the wreckage. If you are tracking the flow of capital, if you see the loop for what it is, I want you to go to the comments right now. Drop a helicopter emoji. Leave a helicopter emoji to let me know you are monitoring the injection of liquidity from above. Let me know you are hovering over the disaster zone, ready to pivot when the engine finally seizes. Only those with the high ground will survive the autopsy. I want you to imagine a hermetically sealed chamber. There are no windows. There is no ventilation. The air is recycled, stale, and beginning to run thin. In the center of this room sit two entities. On the left, you have the titanic infrastructure of big tech. On the right, the starving, desperate ambition of an artificial intelligence startup. Between them sits a single briefcase containing $10 billion. Watch the hands. Do not watch the faces. The giant on the left slides the briefcase across the table. The media calls this a strategic partnership. The headlines scream about innovation and the future of humanity. But look closer at the contract attached to the wrist of the recipient. The startup takes the money, but they are not allowed to leave the room. They are not allowed to buy better hardware from a competitor or seek cheaper energy costs elsewhere. The contract mandates that they must open that briefcase and hand the money immediately back to the giant on the left in exchange for cloud credits. The money has traveled in a perfect circle. It left the bank account of the giant, touched the hand of the startup for a fraction of a second, and returned to the revenue column of the giant. This is not capitalism. This is a round-trip ticket to economic oblivion. This is the digital Ouroboros, the ancient symbol of the snake eating its own tail, forever consuming itself to sustain an illusion of life. We are performing an autopsy on the concept of revenue itself. In a healthy organism, revenue is proof that you have created value for a customer who earned their money elsewhere. In this disease system, revenue is manufactured. It is synthesized in a lab. Big tech is printing money, handing it to a shell company, and forcing that shell company to buy their product. This is the forensic definition of round-tripping. It is the exact same mechanism that rotted the core of the energy markets in the early 2001 era before the Enron collapse. But the scale we are looking at today makes Enron look like a lemonade stand operating at a loss. We are talking about a loop involving $176 billion of capital expenditure. Let us cut into the tissue of these financial statements. When you see a massive cloud provider report a 30% growth in Azure or Google Cloud or AWS revenue, you assume that 30% comes from real businesses buying real services to sell real products to real humans. That assumption is fatal. A terrifyingly large percentage of that growth is simply the cloud provider's own investment capital coming back home, disguised as a customer. They invest $4 billion in an AI model. That AI model is required to spend $4 billion on the investor's servers. The investor books the $4 billion as revenue. The stock price soars because the algorithms see growth. The executives sell their stock options at the peak. And the startup? The startup is left with a massive valuation but zero actual cash flow because every dollar they raised was earmarked for the vendor who gave it to them. This is a perpetual motion machine of accounting, and like all perpetual motion machines, it violates the laws of thermodynamics. The mathematics is brutal and unforgiving. Every time that dollar makes a round trip, it loses value. It loses value to energy costs. It loses value to the depreciation of the graphic processing units. It loses value to interest rates. Entropy is eating the system alive from the inside. They are burning the furniture to heat the house, but they are listing the smoke as an asset. This creates an ecosystem of zombie unicorns. These are companies with multi-billion-dollar valuations that are effectively insolvent the moment the investment round closes. They are on life support, and the breathing tube is connected directly to the marketing budget of their investor. This is not fiction. This is the balance sheet of the modern technological industrial complex. When we look at the capital expenditure numbers, the CapEx, we see companies spending $50 billion in a single quarter to build data centers. Who are they building them for? They are building them for the very startups they are artificially propping up. It is a closed loop of logic that assumes the demand for artificial intelligence will be infinite and price inelastic. But the forensic evidence suggests otherwise. The demand is being subsidized. The demand is being bribed into existence. If you stop the injection of investment capital, the revenue for the cloud providers collapses. If the revenue collapses, the stock price implodes. If the stock price implodes, the investment capital dries up. It is a suicide pact, written in Python code and buried in the footnotes of quarterly earnings reports. I want you to understand the severity of this necrosis. Real economies are built on the exchange of goods for sovereign currency derived from labor or tangible assets. This economy is built on the exchange of hype for credits derived from speculation. We are looking at a Potemkin village of finance. From the outside, it looks like a bustling metropolis of commerce. The gross domestic product numbers look inflated. The tech sector seems invincible. But if you walk through the front door of these startups, you realize there is no building behind the facade. There is only a server rack and a wire transferring funds back to the landlord. This is the illusion of liquidity. It looks like water, but it is actually gasoline. The market believes it is swimming in a pool of infinite revenue growth. But one spark, one failed quarterly report, one regulatory crackdown, one realization that the AI models are hallucinating profits just as much as they hallucinate facts, and the entire pool ignites. We are witnessing the industrialization of bag holding. The venture capitalists and the cloud hyperscalers are playing a game of musical chairs where they own the chairs, the music, and the electricity. But they are running out of players to sit down when the music stops. Do not be fooled by the complexity of the jargon. Do not let them intimidate you with terms like strategic alignment or synergistic ecosystem. Translate it back to the language of the crime scene. It is money laundering. It is washing cash through a startup to make it look like organic demand. And when the forensic team finally unzips the body bag on this era of tech investing, the cause of death will be listed clearly. Multiple organ failure due to the consumption of toxic assets. The digital Ouroboros will eventually choke. The snake cannot eat itself forever. Eventually, it runs out of tail. And when it does, the hunger that follows will devour everything in its proximity. Imagine this. You are standing in a sealed room. The air is finite. Every time someone breathes out, another person breathes that same air back in, convinced it is fresh oxygen. This is the exact atmospheric condition of the current artificial intelligence economy. We are looking at a clinical diagnosis of acute liquidity asphyxiation. The patient did not die of natural causes. The patient was strangled by its own accounting. We are entering the final stage of the autopsy. The verdict is not merely a correction or a bear market. It is annihilation. We need to dissect the nature of this $176 billion loop with the cold precision of a coroner. The mechanism of death is what forensic accountants call round tripping. It is the oldest trick in the book of financial fraud, yet here it is, dressed up in the shiny clothing of the future. The anatomy of the crime is simple. The big tech giants, the cloud providers, take $10 billion of their cash reserves. They invest that $10 billion into an artificial intelligence startup. The market cheers. The venture capitalists pop champagne. The valuation of the startup skyrockets to astronomical levels. But look closer at the term sheet. Look at the fine print that the media ignores. That investment comes with a condition, a mandate. The startup is contractually obligated to spend that same $10 billion on cloud computing services provided by the investor. The money leaves the right pocket of the tech giant. It travels to the bank account of the startup. It stays there for 5 minutes. Then it travels right back to the left pocket of the tech giant, now labeled as revenue. This is not economic growth. This is accounting gymnastics. This is a kinetic energy machine that generates heat but no motion. When we strip away the marketing narratives and the buzzwords about large language models, we are left with a terrifying mathematical reality. The revenue figures you see on the quarterly earnings reports are hallucinations. They are legally sanctioned fictions. The company claims they made billions in cloud sales, but they essentially bought their own product using a middleman to wash the transaction. This creates an illusion of demand where there is only a desperate need to justify capital expenditure. The brutality of the math is inescapable. Real economies rely on an external injection of value. Someone somewhere outside of the loop must buy the product. A real customer, a person buying a phone, a business buying software to actually increase productivity. In this closed loop, there is no external customer. The dog is eating its own tail, and the market is pricing the dog based on how much weight it gained from the meal. We are staring at a massive misallocation of capital that rivals the South Sea bubble or the tulip mania. But this time, the tulips are silicon chips that depreciate the moment they are plugged in. Think about the hardware. We are talking about hundreds of billions of dollars spent on graphics processing units. These are not assets like land or gold. They are not sovereign tangible assets. They are depreciating liabilities. Every second those chips run, they lose value. They burn electricity. They wear out. In 3 years, they will be obsolete scrap metal. And yet, they are currently valued on balance sheets as if they were the crown jewels of England. This is the definition of a toxic asset. When the music stops, and it always stops, the liquidity will evaporate instantly. The startups will run out of the initial investment cash. They will need more money to pay for the servers. They will go back to the tech giants. But the tech giants will realize that the revenue they booked was fake. Their earnings per share will collapse. Their stock price, inflated by the artificial intelligence premium, will crash. The collateral damage will be absolute. Pension funds are exposed. Retail investors are exposed. The entire passive investing complex is exposed because the indices are weighted heavily toward these exact companies. This is not a prediction of a stormy day. This is a calculation of a hurricane trajectory. The pressure is dropping. The structural integrity of the market cannot withstand the weight of its own deception. We are seeing the formation of a black hole where capital goes to die. The illusion of liquidity is the most dangerous drug in finance. It makes you feel safe right up until the moment the window closes. And when the margin calls start, they will not come as a polite request. They will come as a liquidation order. The smart money, the insiders who built this casino, are already cashing out. They are selling their shares while the retail public is still buying the hype. They know the autopsy report before the patient is even dead. You need to understand that this is a binary outcome. There is no soft landing for a Ponzi scheme of this magnitude. There is only the sudden, violent realization that the money is gone. We are witnessing the greatest destruction of wealth in modern history, disguised as the greatest creation of wealth. The verdict is final. The cause of death will be listed as systemic organ failure due to the ingestion of phantom revenue. The closed loop is tightening. The asphyxiation has begun. I need to know who is watching this from a safe distance. I need to know who has separated themselves from the herd and is observing the crime scene from the high ground. If you are ready to rise above the smoke and the fire, if you are prepared to watch the collapse from a position of safety and sovereign control, leave a helicopter emoji in the comments right now. Show me that you are monitoring the injection of liquidity from the sky, not from the slaughterhouse floor. The chopper is leaving. Do not be left on the ground.